Welcome to the final explainer of our course on ASC 310 receivables. Seriously, huge congratulations are in order. You've made it to the capstone. Up to this point, you've booked the entries, you've tracked the life cycle, and you've analyzed the aging reports. Now it's time to see exactly how those receivables are presented to the outside world in your published financial statements. Let's dive right in.
Here is our roadmap for today. We'll do a quick welcome to the finish line, then look at how we actually present these financial statements, followed by the required notes disclosures. Then we'll shift gears into a bit of a survival guide, covering common mistakes with timing and entries, as well as mistakes with judgment and risk. Finally, we'll wrap up with our core course takeaways.
All right, Section 1, welcome to the finish line, taking this from the life cycle to the statements. And moving right into Section 2, presenting financial statements. This is essentially the blueprint of ASC 310.
So, you've built this receivable from the ground up through your daily accounting ops, right? But the presentation of these numbers is just as heavily regulated as the journal entries themselves. Receivables don't just sit in one place. Let's start with the balance sheet. Notice how classification hinges entirely on one thing, the 12-month expected collection window. If we expect to collect within 12 months, it's a current asset. We take the gross accounts receivable, subtract the allowance for credit losses, and boom, that equals our net receivable. And you can present that net figure as a single line item right on the face of the balance sheet, as long as the gross amount and the allowance are disclosed in the notes. On the flip side, we have non-current assets. If you don't expect to collect within 12 months, think long-term notes receivable, it's classified as non-current. And hey, if you have a long-term receivable that has a portion due within the next 12 months, you literally have to split that portion out and present it as current.
Now, what about the income statement? Where did the related revenues and expenses actually live? Well, for interest income, it completely depends on your core business model. If lending is your bread and butter, like it's a core activity of the business, then it's presented in operating income. If it's not, it sits below the operating line. Meanwhile, your credit loss expense is typically going to sit within your operating expenses. You can show this as its own separate line item, or sometimes it's tucked away within a broader selling, general, and administrative category, which we usually just call SG&A.
Next up, the cash flow statement. Specifically, we're looking at the indirect method here. Under this method, the change in accounts receivable is a working capital adjustment within your operating activities. And honestly, this brilliantly illustrates the whole logic of cash flows. Think about it. An increase in AR must be deducted from net income. Why? Because you recognize the revenue, but you haven't actually collected the cash yet. Conversely, a decrease in AR gets added back to net income. This happens because the cash you actually collected in the period was higher than the revenue you recognized. It's an absolutely vital adjustment to bridge that gap between accrual counting and the actual cash sitting in your bank account.
Which brings us to Section 3, Required Notes Disclosures. Time to read the fine print.
Do you know the primary statements only give you a bird's eye view, which is exactly why ASC 310 and ASC 326 mandate some serious, detailed disclosures in the notes to ensure full transparency. You absolutely must include these 6 items. First, the gross receivable balances and the allowance for credit losses. Second, an allowance roll forward. This needs to show the opening balance, the provision, write-offs, recoveries, and the closing balance, just the whole progression. Third, an aging analysis of your past due balances. Fourth, your concentration of credit risk. This highlights if you have massive exposure to just a single customer or one specific industry. Fifth, your non-accrual policy, plus the balance of receivables currently sitting on non-accrual status. And sixth, troubled debt restructuring, or TDR disclosures, if that applies to you. Just a quick note on that last one, it's specifically for entities that haven't yet adopted CECL. But together, these notes really pull back the curtain on those single aggregated numbers presented on the balance sheet.
Okay, so we've seen the gold standard of presentation. But let's be real for a second. What goes wrong out there in the real world? What actually happens when a busy accounting team, completely slammed during month-end close, decides to take a few shortcuts? Let's transition from the textbook theory into a practical survival guide.
Section 4, Mistakes with Timing and Entries. Let's look at transactional errors.
Let's look at the classic transactional traps teams fall into when they're just trying to save a little time. Check out the first row, recording a receivable before goods are shipped or a service is actually delivered. Why does this happen? Usually an eager team raises an invoice early and just books it when the document is created, rather than waiting for actual delivery. To prevent this, you have to tie that entry date directly to the revenue recognition date. You only record AR when control actually transfers to the customer. The second mistake is recording a write-off as a direct expense instead of running it through the allowance. Someone might try to save a step by debiting bad debt expense and crediting AR directly.
No way. The rule here is absolute. Write-offs must always go through the allowance. You debit the allowance and you credit AR. Remember, you already recognize the expense when you first increase the allowance. Don't double count it. And finally, a total classic. The AR subledger doesn't reconcile to the general ledger. This usually happens when payments or adjustments get posted directly to the GL, completely bypassing the subledger. The only prevention here is strict, unwavering discipline. You have to reconcile the subledger to the GL every single month and ensure every single AR entry updates both systems.
And speaking of journal entry mistakes, we really need to talk about recoveries. A super common shortcut here is a team recording a debit to cash and a credit to credit loss expense just to quickly process a recovery. Never go directly to the P&L. A recovery always requires two proper steps. Step 1, reinstate the receivable and the allowance. Step 2, then collect the cash. If you skip step 1, you completely destroy the historical accuracy of your allowance data, and that's going to cause major headaches down the line.
Section 5. Mistakes with judgment and risk. Let's talk about analytical lapses.
Moving beyond simple keystroke errors, let's break down these analytical lapses. First up, carrying a stale allowance. This happens when teams just blindly roll forward prior period rates without actually rerunning the aging report at period end. You simply can't do that. You must run the aging report at every single period close and recalculate using current balances and updated loss rates. Next is undiscounted long-term receivables. Teams will sometimes carry long-term notes in face value, completely ignoring the time value of money. But listen, if you have notes with payments extending beyond 1 year, or if they bear below market interest rates, you have to discount them to their present value right at inception. Lastly, allowing interest to just keep accruing on non-accrual receivables. This is usually caused by skipping a dedicated non-accrual review during the period close. You have to actively identify all past due or troubled receivables at every close, place them on non-accrual status when collection becomes uncertain, and immediately reverse any accrued interest. Skipping these analytical reviews doesn't just save time, it severely distorts the financial reality you're presenting to your stakeholders.
Now, I really want you to pay attention to this specific threshold, 10%. A massive analytical mistake is failing to assess concentration of credit risk. So often, teams will just slap a flat aging pool rate across all their customers without actually stopping to review the really large individual balances. But the rule of thumb here is crucial. If you have any single customer with a balance exceeding 10% of your total AR, you cannot just lump them into the general pool. You must pull them out, abandon those flat pool rates, and assess their specific credit risk individually.
And finally, Section 6, Final Course Takeaways, Returning to Principles.
You know, if you look closely, the vast majority of these mistakes share one common root cause: trying to apply a fast shortcut to a situation that actually requires real, professional judgment. So what is your ultimate takeaway from this entire course? It's simple. Discard the shortcuts. Return to the core accounting principle, apply it carefully to the facts in front of you, and document your conclusion. If you do that, your receivables are always going to be an accurate reflection of economic reality. So as you head back to tackle your own month-end close, I want you to ask yourself, what hidden shortcuts are currently distorting your financial statements? Think about it. Thank you so much for joining me on this deep dive in ASC 310, and I'll see you next time.